mid-cap index up about 0.25%. I think the small-cap index is absolutely flat to begin this session. 640 stocks are higher, about 1,000 stocks are lower, but this is the very first, minute of the market open. Heat map, perhaps, if we have it, just quickly gives you a view of how things are looking. It's mostly in the green, but you got about 14, 15 names which are in the red. Reliance is at the bottom of the screen. There's a 2% pop. Surabhi.
Yeah, Reliance was up and about, but look at Shriram Finance, another 8% down after an 8% tumble on Friday. These large NBFCs, it's a rare disappointment of such magnitude. Remember, credit cost is much higher than the street estimated. There's pressure on margins, and there seems to be a bit of an NPA concern building up as well. So that's the big result casualty. But out of the Nifty, the other major one is L&T Finance. Don't take your eye off on that, because L&T also started 8% down on L&T Finance, 8% down on Shriram Finance. Same situation with L&T as well. There's pressure on margins, and the gross NPAs have inched up slightly, and the street just doesn't want to have any of it. So there are your result disappointments for the morning. But otherwise, the market's holding up. So let's go back to the green side. Reliance is still in leadership position, 1.5% up on the stock. M&M is reacting well to the news of the purchase of SML Isuzu, 1% higher. Actually, since I'm talking about the deal, let me check SML as well. SML is down 9%, is very quickly correcting that arbitrage. Remember, Sud just told us the closing on Friday was 12% higher than where the open offer price is. Open offer is coming in at 1,555 crores, roughly 54 crores, 55 crores. So it's very quickly correcting that arbitrage. Anyway, other large stocks that are moving higher, Dr. Reddy's, Eternal, IndusInd Bank, BEL, these are your other gainers. SBI and Axis Bank, the banks are looking good. SBI Life is continuing its good form from last week as well, 0.5% higher. There's some gain on names like Hindalco as well, L&T. So otherwise, the Nifty is fine. And lots of other large cap stocks making up for the disappointment. But these are the names that are on the downside. HCL Tech is slightly lower, 1.5% down. Today is a day of big headline stock moves, really. Nifty otherwise is fine. 100 points up to begin with. Nigel.
All right, few stocks that are on the radar. RK Forgings, they've uncovered some discrepancies in inventory that could dent the company's net worth by around 4 to around 5%. So RK Forgings actually the stock that's got a hard knock this morning. I think the stock should come up for you on the screen. Tejas Networks, that's the other one that's losing out in trade. There were a couple of one-offs in those numbers, mind you. But for the time being, the street has just looked at the absolute margin number, and that's the reason why that stock is down closer around 10%, though it's recovered in the last few minutes from the low point of the day. Pull up Ramkrishna Forgings. I think that as well should come up for you on the screen because of those, discrepancies in the inventory. Motilal Oswal continues to see some selling. Remember, Friday's trading session, it came out with a set of numbers, but the stock was under pressure. Mr. Ramdeo did clarify on that, but for the time being, another 4% lower. Indus Stars, that's a stock that's opened up higher because they'll be considering, a buyback at their board meeting on April 30th. So on the back of that, that stock is doing well. Stocks that are really doing well from the banking pack, DCB Bank and RBL Bank, both of them flying away in today's trading session. So the start is pretty okay for the Nifty. You have SML Isuzu. Those that were buying for the deal, they seem not too happy about the deal because the pricing is something that's hurt. And, Mahindra's got a good deal. But for shareholders of SML Isuzu, not too great. Stock down 10%.
The stock had already rallied this year. Yeah. SML, in anticipation of this deal and how many suitors are quoting it, is up 20% in 2025 when the Nifty is absolutely flat. So it's perhaps in the price. And then this is a formula-based thing, the open offer pricing. And I guess that final formula price, now the stock's very quickly moving towards that, which is 15.54.
RK Forging, I don't know if you've put up the
I just mentioned.
Okay. So the stock maybe... So that there's a release which has been... And I think there's a call at 11 o'clock as well. So there is an inventory mismatch which has been reported. A release to the exchanges says that the promoters will make good the difference by permissible instruments, etc. So keep an eye out on this one. It just came to my notice because last week it was a top loser. One of the top losers, when I looked at the NSE 500 list, it was down about 12%. Friday to Friday, this morning is down about 5%. And now we've got some clarification coming through as well on RK Forging. All right, well, what else do we have? Dixon is up 2.5%. It's got, is it that Apple news flow? Although Dixon doesn't work with Apple, but it's got the entire Android ecosystem on it. Indus Tower about 2.5 higher. Blue Star, I was talking about this with Mitesh earlier. Blue Star lost 14% last week. It's coming up with about 3.5% pop. There is Kalyan Jewelers, which is up about 2.25%. Actually, almost 3% on Kalyan Jewelers this morning. There is Kim's, the hospital company, which is up 4.5%, 704 on that one. Torrent Pharma is up 2. PG Electroplast is up about 2.5%. And so it goes. But volumes are, limited. If you just sort of go beyond the first 10, 12 names, as is the case most of the times. But it's all, Shriram Finance and IDFC First is down about 2.25% as well. Chola Finance is down 3%. Poonawalla FinCorp is down 3%. Lal Path Labs, we just spoke with the company, is down about 4% as well this morning. So, that's the overall picture. Market breadth is flipping a little bit on the downside. So keep an eye. 1,400 stocks down, about 850 stocks which are higher. Pratik Gupta is with us, CEO and co-head at Kotak Institutional Equities. Pratik, good morning. Good to have you with us here. As of last Friday's close, Nifty is India's the best performing large Asian market from the Trump Liberation Day tariff announcements from the close of 2nd of April. We've crept back into the positive territory YTD. We just played out sound bites of Ramdev Agarwal, who was telling us that in his interaction with foreigners, what he's hearing is that global mutual funds, foreign investors, etc., are underweight the US and the positive Europe and India. That's the feedback that he got. What are you picking up, just in terms of foreign investor sentiment and from a flows perspective? Because last 8 days, there's some 32,000 crores worth of foreign money which was coming.
Good morning, Prashant. Yes, I would agree with that assessment broadly, that foreigners are definitely, especially the non-US investors, the Europeans in particular, for example, they're looking at India or looking to firstly get out of the US, trim their holdings in the US, and some of that money is finding its way back into markets like India. And even globally from the US, we are seeing some increasing interest from asset allocators to investing in emerging market funds. The number of inquiries has gone up. The passive funds have seen big flows coming into EMs, and India is benefiting as a part of that. Within that, when we speak to our clients globally, we are seeing that a lot of folks were seeing India as sort of the least bad emerging market, meaning that there were issues with other markets, especially China in particular, where despite the cheaper valuations over there, a lot of folks are still worried about the long-term implications of the trade war. Even before the trade war, China was going through a pretty severe slowdown. And now you have the trade war, and who knows how that thing pans out. So despite the cheaper valuations in China and despite the somewhat more expensive valuations in India, we had been through a bit of a market correction in February and even in March. So we had started seeing some interest coming back in. So to that extent, yes, we are an expensive market, but just given the lack of better alternatives, we were beginning to see some money coming back into India. Now, the one change which has happened last week is obviously this terrorist attack in Kashmir, and we don't know how that pans out, how badly it escalates. So that's something which is, I think, once again going to be a little bit of a fly in the ointment for the short term. But I think fundamentally we are moving in the right direction.
Pratik, hi, morning. Good to have you on the show today. So if you're saying we're fundamentally moving in the right direction, if you could sort of give some further indication on that. If we leave aside the tariff issue, for an instance, leave aside what's happening on the security situation, let's just talk earnings, right? Because that's the bread and butter of any market. There, we still hear of several concerns. And look at the accidents this morning. NBFC is showing up some asset quality issues here and there. On earnings, what are you penciling in? Because the big worry is that we're not out of the woods as yet, and whether we are going to be seeing more downgrades for FY26 as the year progresses.
So, Surabhi, yes, on the earnings front, we've anyway been conservative for quite some time. And we have, even right now, I believe our estimates would be below the street estimates. At Kotak, we're penciling in about 12% earnings growth in FY26, followed by another 14% in FY27. And you're right. I think we are likely to see more earnings cuts. So maybe that 12% becomes, we end up being 9 or 10%, which would be in line with the nominal GDP growth. But I think what I meant where things are improving is things like, for example, the RBI is becoming a lot more, I guess, they're cutting interest rates given the decline in the inflation level. Liquidity is improving quite dramatically, and RBI is committed to providing more liquidity. The stance has moved to accommodative. And even from a regulatory perspective, RBI is becoming a lot more sort of business friendly and removing some of the onerous regulations. LCR, for example, has been pushed back and diluted. So one is the RBI stance. Second, I would say we've seen about almost a year of government capex being somewhat slow. And you've had a change at the helm in the finance ministry, 4 new secretaries coming in over there. So we think once again, the capex, the government capex cycle, which was anyway sort of picking up, will get a fresh, with these fresh faces at the helm. I think you'll start seeing that being pushed through more aggressively. On the currency front and trade war front, Scott Bessent, the US Treasury Secretary, said last week that India and the US are quite close to signing a trade deal. Now, we remain skeptical as to what will be the contours of this trade deal, given that farm products or even 100% retail, 100% FDI and retail is going to be quite difficult for India to agree to. But nonetheless, if they manage to work out something, that would be a pretty big positive. And then not to mention things like a normal monsoon, which should help. And so the point about earnings remains, and which is why we are not bullish on the market, but neither are we saying that we are in an extremely expensive zone. What's keeping us cautious right now is still the valuations. 10 days, 15 days back, we were beginning to get into slightly attractive territory. And the way the rally has happened in the last 10 days, again, we've become sort of more towards the expensive side once again. So again, we're back to being somewhat cautious again.
Okay, all right. Hi, Prateek. Good to hear your thoughts. As always, a little bit cautious with a hint of optimism on select spaces. Let's talk about the changes that you've made, in your portfolio. Reliance Industries, that's one of the key reasons that we're holding in the green this morning. And the stock actually had seen a big correction of close to around 20%, and it wasn't holding one end up for the Nifty. But in the last couple of weeks, in fact, it's found its form. You'll have gone ahead and increased your weight out there. Give us the rationale.
So I think the main reason for Reliance has been the improvement in the performance of its retail business, where some store rationalization and pickup in the retail revenues, that's really helped a lot. And not to mention the telecom business is doing well, potential for tariff hikes later this year. And also in the context of the overall market, where we think there will once again be a flight towards large caps. The small mid caps are no longer as attractive as they were perhaps 1-2 years back. So in that context, and also given the decline in global crude oil prices, that also helps. So with all of those considered, plus the strength in the retail business, the outlook for the retail business and the telecom business, given that the core petchem business is chugging along quite well, from a valuation perspective, Reliance is beginning to look attractive compared to the other options you have in the market, say in the consumer discretionary or consumer staples, or even IT services, where the stocks have come off, but there's a pretty sharp earnings downgrades happening over there. So in that context, that's the part of the reason for Reliance is again amongst the least bad alternatives out there within a model portfolio.
That's the problem, right, Prateek? I mean, just to go back to what you said, 10% move and suddenly you're worrying about valuations because there's no help from earnings coming through. If there was a bit of lift from earnings, then you kind of sort of can, it gives you leeway. You can imagine higher multiples, etc., but that is just not there as of now. Do you think it'll be a second half story? It's possible. What's your sense? The RBI is not holding back in terms of helping on liquidity, etc. Maybe you need something, those tax cuts, etc., perhaps will start to come in from May, the impact of it at the margin. I don't know how much though, but can it be a H2 story, earnings?
Prashant, yes, that's what we are banking on. We think it will be a second half story, not just one is obviously earnings. By then, hopefully, the worst of the earnings cuts would have been, we'll probably have a weak March quarter, possibly a weak June quarter as well. And September, December onwards, we start improving on a Q-on-Q basis and on a YOY basis. Projections are for a normal monsoon, so that should help as well. By then, I think the impact of the RBI rate cuts, the better liquidity environment, a more stable rupee, all of these things, and a lower oil price, lower commodity input prices for a lot of the companies, all that will start feeding in. The problem right now is we have a very, very weak demand environment, which has been continuing for the last 2-3 quarters. And as I said earlier on, with the weaker, the lower interest rate environment in India, plus hopefully you'll start seeing government capex picking up more steam, both central government and state capex picking up more steam by second half FY26. All of these things should hopefully start improving the overall earnings trajectory. And the markets, yes, you're right. We're once again back to almost 21 times FY26 earnings. Again, trading at almost a 95% premium to China, for example, to the MSCI EM index. So again, we're back in expensive territory. Most investors globally are sort of frustrated that they missed the boat in the last 2-3 weeks, just when they were sort of getting ready to deploy more capital. A little bit of money comes in and the market just runs away. So a little bit, again, back in the sort of neutral to cautious zone again.
Yeah, all right. Thanks a lot, Prateek, for joining in. Good to hear your thoughts as always. Rational as always. Preferring the large caps, the markets may not be out of the woods, and maybe earnings could disappoint on the downside, but optimistic about the second half of the year. Let's get straight to our next management on the show. We have Tata Technologies. The revenue came in a little weaker than expected. EBITDA margins as well did see some bit of improvement. We have with us Mr. Warren Harris, the Managing Director and CEO at Tata Technologies. Hi, Warren. Good morning, and thanks a lot for joining in. Well, how do you see things spanning out? The first half of the year could have its share of uncertainties because the globe itself is a bit of a flux. The ER&D space has been having its own challenges. So what are you penciling in terms of the first half of the year? And are you expecting a recovery in the second half?
Yeah, well, we expected about a month ago. We expected a very strong start to the fiscal year. I think the tariff uncertainty has certainly undermined that, and the current visibility that we have is that the first quarter is likely to be soft. But our optimism in terms of the full year is really informed by the fact that a lot of investment decisions were delayed last year. You know, if you look at the United States, there was a lot of uncertainty in terms of who was going to be in the White House. We've seen a lot of regulatory change and incentives for EVs run off in Europe. We expected that situation to be clarified. We were engaged in a lot of really encouraging discussions with our customers leading up to the end of the fiscal year, and we had a lot of optimism. But you know, clearly the tariff situation has confused that, and we're hoping that will provide some we'll get some sort of understanding of how that's going to pull through in the next month or so.
All right, Warren, request you to stay with us for the time being. We're just hopping across here. Dr. Anish Shah, post Mahindra & Mahindra acquiring stake in SML Isuzu. Let's go there and we go back to Warren.
It was under the scanner of capital allocation 5 years ago, and a business we decided we had a lot of strengths we could turn around. It has done very well over the last 5 years, in line and slightly higher than our expectations as well. We've got a very strong team now and a good product portfolio. Rajesh will talk about the details of the business, and then we'll have Vinod up here as well to answer questions that you may have. But this is a business that we really like and we feel can do a lot, and which is where we got the opportunity of an acquisition which we feel will position us very well, an acquisition which we feel is an appealing one and a very strong strategic fit. So with that, let me invite Rajesh to come up and talk about some of these details.
Thanks, Anish. So we've just announced on Friday evening, as you know, the acquisition opportunity of SML Isuzu, as it's called. We're looking at buying 59% stake of SML at 650 rupees per share. Sorry, the 59% stake includes a stake from Sumitomo and Isuzu both. There will be an open offer that gets triggered based on the regulation, and that will be for up to another 26%. And
we'll cut back, and hear out what Rajesh as well as what Dr. Shah have to say. We'll keep getting you snippets and keep an eye out on the bottom of your screen. All the most important flashes will be out there. Warren, thanks a lot for waiting by. As you were telling us, the global environment is still a little bit uncertain. But what are you penciling in for the year? I was looking at a JP Morgan note. They are factoring in, single-digit revenue growth with margins staying more or less flattish. Would that be a little bit conservative? Are you optimistic if things recover, you can do better than what they're estimating?
Again, I think a lot will very much depend upon the macroeconomic environment, and again, specifically whether or not we get the type of clarity that I think the markets are looking for in and around tariffs. If we get that, and we get that within the first quarter, I would be very bullish that we can do better than single-digit growth as far as this fiscal year is concerned. Again, a lot of our customers have built up a need to invest over the last 12 to 18 months. And as soon as there's clarity, we believe a lot of that will be discharged, which will provide tailwinds for organizations like ourselves.
An outside chance you even give double-digit revenue growth?
Well, I think we're certainly planning for that. And so at the beginning of the year, we were optimistic that that would be the sort of North Star of the achievement that we were looking for. But again, we've got to be very cognizant of the macroeconomic environment and adjust our expectations accordingly.
Warren, hi, good morning. Prashant here. It's a very uncertain world, isn't it? As you began by saying, I mean, companies don't know where they should build. I mean, that's the basic starting point, whether they should move, not move. So in that sense, I mean, I guess investment decisions take a bit of a backseat. JLR, for example, is an anchor customer for you, about 15% of revenues.
Yeah.
Is this, what can you do? I mean, this environment, say, for example, if it stretches through for the next many quarters till the end of the year. For example, I mean, India is said to be the first in line for a deal, and that is only sometime in the fall when we start to see the outlines of a deal. Yeah. So if this uncertainty stretches for the next 2 quarters, what can Tata Tech do internally to mitigate some of the impact, especially on operational efficiency, etc.?
Well, I think you make a very good point, Prashant, about the need for clarity as far as investments are concerned. But I think one of the things that I would say is that the business that we are in, the manufacturing sectors that we are in, they're essentially product-led sectors. And so the automotive industry, for instance, if you're not making investment decisions today, you're compromising or mortgaging your future in 2 to 3 years' time. And a lot of investment has been put on hold in the last 12 to 18 months. And there's a lot of latent demand to deploy that investment and make decisions on products. I think different markets will play out in different ways. We're seeing India being somewhat immune from the tariff play, particularly those manufacturing companies that are focused almost exclusively upon the Indian market. I think Europe is making decisions in terms of interjecting resilience into their supply chain and standing in a position that's less dependent upon the United States, for instance, and the US is very much committed to the repatriation of manufacturing. And so our approach to those markets are going to be calibrated in the context of the specific opportunity that we see. So we're having to be agile, but at the same time, we're hoping for some of the volatility that we've seen in the recent past to settle down.
All right, final word from you, Warren, before we let you go. Since growth is going to be a little bit uncertain, what about on the margin parameter? You have been holding around this 18.5% odd mark. You want to give us a range?
Well, I think our priority first and foremost will be to continue to protect margins. I think we've demonstrated our ability to do that in FY25. I think you've seen also in the fourth quarter the flow through of the contribution of the joint venture that we have with BMW. So net profit and earnings per share has significantly improved. And again, our priority in the first part of the year will be to protect margins. But if we see growth coming through, and we're still confident that that will happen, then we will certainly look to improve upon the margins in which we finish the year.
Warren, great speaking with you. Thank you very much. We wish you all the best of luck in this tough, uncertain macro environment. But as you said, a lot of the pending investment decisions also means latent demand when things clear up a little bit. By the way, the market here in India is continuing to chug along very nicely. I think we're at the day's highest point, 24,200. We're up 0.7% at this stage. So some big movers there coming through in a bit from now as well. Cholamandalam Investment Finance is the next company which is on radar. Reported a strong set for the fourth quarter. We have Arul Selvan, President and Chief Financial Officer of the company, to take us through some questions. Sir, good morning. Great to have you with us here. Prashant this side. And a good set. But although I want to start with something slightly on the negative side, which is credit costs, which remained high at about 1.4% in a seasonally strong quarter. Could you give us a sense of what you saw and what we should expect in FY26, sir?
Sure. See, the credit cost had not reduced to the extent it would have reduced in any given Q4, as if you see last year Q3 versus Q4, across products, including vehicle finance. So to that extent, there had been a little bit of a higher cost. Apart from that, what we have also done is the business on fintech, which we have been exiting. We created a certain one-time provision because as we move down and reduce the exposure there, you will have certain hits on the balance portfolio, which is running down. So to that extent, we created incremental provisions. Both these put together has kept the credit cost little elevated. FY26, we should see around 15 to 20 basis points credit cost on a full year basis as compared to current year. That's what we are targeting as we move into FY26.
Mr. Selvan, has stress generally sort of increasing? Is it what is your sense? Also, talk to us a little bit about growth. I mean, AUM growth, I think, has slowed down a little bit if you look at on a quarter-on-quarter basis, especially newer segments, etc. Yeah. So what's happening?
See, AUM growth in the traditional products continue to be better, especially in the mortgage businesses. In vehicle finance, it has been a little muted considering the slowdown in the auto. But we are moving into other products like used and two-wheeler to keep the vehicle finance AUM, chugging along. New products, yes, there has been a bit of a reshuffle as when we reduce the fintech exposure, we have consciously brought down the exposure there, but that would be compensated by our foray into consumer durables, which we have started. We have been doing Samsung Mobile earlier. Apart from that, we have now started other products also. So that would start picking up to make the new product disbursements and the AUM growth bring back to its old levels. However, overall, unsecured, we are holding our target at around 10% of the overall portfolio, so that would not breach that number. But other products will continue to grow.
So 10% is the capping you are putting at, putting for unsecured loans. Yes. And overall growth has been really solid, sir. I'm looking at the AUM growth. I mean, you're up almost 27% year on year, 6% quarter on quarter. All segments have done well. But talk to us about your gold plans, because the gold market is where there's a lot of competition. NBFC is fighting to retain their turfs. Banks have been aggressive. The RBI is changing regulation. What are your plans on the gold financing side?
No, like any other product, we would start slow and build it over a period because, as we don't jump in with both legs into the water, we will go slow. We are starting with 100 and odd branches initially. So we are targeting around 1,500 to 2,000 crores in the first year. As we move on and we get comfortable with the product, we will scale it up. As you know, here we cannot leverage the existing branches. We need to create new branches. So we are in the process of creating new branches because the operation structure in the branches are different. So we need to create new branches. We are in the process of doing it. We have already started opening branches across East and South region, but we will move slowly. We will. Sorry. Yeah.
Sorry, sir. My question was, we were just trying to understand why you're looking at this avenue. Isn't this already a crowded market? Like I said, so many players, ever-changing regulation, fight for turf. I mean, do you feel that your existing large segments like CV financing, etc., do you see a plateau ahead? Is that why you are opening up the gold avenue? And again, as a percentage of the book, like you mentioned, unsecured won't go beyond 10%. Eventually, say 2 years down the line, as a percentage of the book, where would you want gold to stabilize at?
See, it's not that the other products are slowing down and that's where we are going into gold. Our long-range plan is that Chola will be a complete end-to-end lending institution where we will offer products, especially in the secured side. We will have the full exposure built across all products. Gold is a product where you have better security and a better return. As I know, it is crowded, but there our credibility will come into play as a credible player and a well-known name, and the trust of the customers would come into play. We have seen a large amount of vehicle finance borrowers also doing gold loan. So that is what we are wanting to try and tap into to see that whether we could bring those customers into our fold. We will do it slowly. As of now, I would rather not give a number on the gold because if it pans out well, yes, we can scale it up. But if it does not, we will be slow to learn and pick up, and we will pick up and do it. It is highly regulated. As you know, the recent regulations have come in which are actually in a way good because we start with the new regulations and we do not have to go back on what we have done. So that all these augurs well for us to enter at the right moment with the full regulatory framework in place.
All right, Mr. Selvan, do you think that, other listed players like, say, Manappuram and Muthu, they were having, too easy a ride and there's an ample opportunity out there. So you said, let's go take some part of that pie.
I don't want to say anything of that sort. Yes, there are enough and more in a growing economy like India. In India, I would rather say the unorganized segment is still a large, the bottom of the pyramid as what we used to project. That's a large segment which is moving into organized segment progressively, and that opportunity with a credible name like Chola can be tapped into and grown. And especially in the rural market where we are strong and our name has been well known, we see that this would be a good opportunity for us to tap into.
All right. And so for the first year, it will be around 1,500 crores is the target. Is that correct?
I would say so, yes.
All right. Let's get a couple of numbers out of the way then. AUM growth for the year, what should it be looking at? And if you could bifurcate it in terms of segments. And also, if you could tell us, what about NIMs? You could get some kind of benefit because the cost of borrowing will go down. So how do you see yields as well as NIMs going ahead?
Yeah, on the AUM first, I will answer that we still target the same 20 to 25% growth as we move into FY26 with all the products, with the mix of all the products coming into play. The mortgage business would certainly have a slightly better improvement as we move into these segments into this year. And on the NIM side, yes, we will see improvement because cost of funds would improve, but it will not be a step change immediately because a large part of our borrowing still is relying on the MCLR change of banks. And if MCLR change, then we will see the step change. Otherwise, the marginal borrowings would be the one where we will see the benefit, but certainly you will see NIMs improving. We will have to share some part of this cost of fund reduction on the floating rate products, which are the mortgage products. But we will see the benefit coming through on vehicle finance where the book is of a fixed rate.
Right. Mr. Selvan, just a quick last clarification before we thank you, sir. On credit cost, when Prashant asked you, you did mention that you're looking at maybe 15 to 20 bips. So that's higher. Could you just tell us FY25, what was the credit cost final number and where do you see it in FY26?
See, we closed the year with around 1.3% on assets on the credit cost, and we think we should do it at around 1 point. We'll close at around 1.2 or lower as we move into FY26.
Your credit cost will go down then, you're saying, from 1.3 to 1.2.
Certainly, our target is to keep it below 1.2, and we should try to do that, yeah.
Okay. All right, sir. Thank you very much for joining in for that clarification. Thank you. We'll just correct that flash as well. Now it's completely clear. From 1.3%, the credit cost for Chola will go down to 1.2% this year. So we'll just rework the numbers on the screen there as well. All right, have to take a very, very quick break on that note. But the discussion with the large lenders continues. Up next, coming up, a conversation with Shriram Finance. Welcome back. As promised, we're continuing a conversation with the earnings analysis for many of the financials. The Shriram Finance stock is still down 8%. And this is after an 8% decline. These numbers, remember, came out just as the market was closing out on Friday. So there's a big slip that's come through. Now, what is the market's concern? There is a large write-off that Shriram did in the quarter gone by. There is some pressure on the margins and some issues around asset quality. So let's clarify all of that and more. We have, of course, our next guest joining in. Thank you, sir, so much for being with us. So, like I said, the market needs a little more clarity on the write-offs that you've taken, your credit cost estimates, and what's really happening with asset quality. So, Mr. Revankar, sir, if you could just start right there. With these write-offs, I mean, the gross NPA level has come down. Are you intending to take more write-offs? And what is the guidance on credit cost? Are you seeing more stress build up?
No, it was a policy decision taken at the board meeting that where we already provided for, we thought for accounts not performing more than 12 months to be written off. So that's a one-off, and I don't think there will be further anything. We just wanted to go forward with those accounts, and the recoveries are still on. It is not that there's no recovery on that. Every quarter we have recovery, and as and when recovery happens, it will become the income part of it.
Sir, can you give some guidance that would help? I mean, what is the kind of recovery, whatever visibility you may have looking at the book right now, say over the next 1 or 2 quarters, and on credit cost as well? I believe it's at 2.42% right now. If you could just clarify, and where do you see this number of 2.42% moving?
See, we have been giving a guidance of around 2% plus or minus 10% on the credit cost, and we are at 2.07 as far as Q4 is concerned, and for the full year it's around 1.92. So we are within the guidance on the credit cost for the whole asset. And going forward also, next couple of quarters, we don't really see any challenges. The market is good. The rural demand is quite good. And the rural economy is also doing well. So we are quite confident the credit cost will be maintained at the present level.
Mr. Revankar, good morning. Prashant here. Good to see you, sir. Is this increase, though, led by some specific geographies? Could you give us a sense of what we've seen? It's one-off, and maybe some recoveries will happen. But the underlying, is it rural is better, but urban seems to be a little slower? Across companies, commentary. I mean, I'm sure you've heard the Maruti management talk about that 2 days back. We just heard from Chola earlier. So give us a sense, what's happening.
No, overall, the economy is doing quite good. I don't really see any pain anywhere. Some geographies, as you rightly put it, central part of India, there were certain challenges in the rural area. That now the rural markets have improved. I don't think there is any further challenge. It is already addressed. The Rabi crop is supposed to be bumper. It will definitely help the rural credit demand and the rural credit quality to improve further. So I don't really see any challenges. The urban is a little slow because the infra spend has been slow by the government for the last full year. I think the infrastructure projects are coming back, and next financial year we should do well. We expect the demand from both urban and rural to go up, and credit quality to remain stable.
Hi, Mr. Revankar. Good morning and good to see you. Ben, let's focus on the gold portfolio. It's a very small part of your business, but we just had a peer who, was just telling us about his foray. Chola's foraying into gold. For you, as a percentage of your book, it's small, but you've seen a degrowth out there. Why is that? And could you tell us what plans you have on this vertical going ahead?
The gold AUM had some degrowth, but if you look at the Q4 disbursements, they were higher by 20% Q on Q. So we are back into gold. We will be growing the book in the next financial year, and we will keep growing. We are also adding more branches to the gold network. It requires certain reskilling and re-engineering the process, which we have already done. So here on, we'll keep growing the gold book.
Okay, all right. So then since you briefly spoke about growth, you are guiding for mid-teens growth. So could you tell us segment-wise what kind of growth are you looking at for the year? And particularly, are there signs that the CV growth is petering out a little bit? Or do you believe that it's pretty much in fine fettle?
We still believe that CV growth is continuous and it will keep continuing to grow. Maybe between 12 to 15%. Last year also we had given the guidance of 12 to 15%. We grew by 14%. This year too, we believe it will grow in similar lines, even though the sales have been flat, year on year have been flat. And it's mainly because the infra spend coming down, bulk material transportation, which is dependent on CV. And whenever there is a slowdown in steel and cement bulk material transportation, the CV demand comes down. However, we still feel there is a shortage of vehicle on the road, and there is a full utilization of vehicle. The repayments on the vehicles are very good. So we continue to believe that demand will come back into CV, and the used vehicle market will grow faster in the next couple of years because the sufficient number of used vehicles are coming into the market now, because the new vehicle sales started 3 years back and it will come into the market. So we believe overall there will be a growth going forward in the CV. Passenger vehicle will grow faster at more than 20%. And of course, MSME gold also will be growing. We will be growing 20% plus. So broadly, I can say that CV and construction equipment will be growing between 10 to 15%. And the MSME, passenger and gold and two-wheeler will grow at 20% plus for the next
overall 15%. Mr.
15%,
Mr. Revankar, on margins, what can we expect, sir?
So margin, we have given the guidance of 8.5. We should go back to 8.5. The last quarter's 8.25 was because of higher liquidity which we are carrying. See, we have been looking for raising long-term resources in the international market. We did have raised certain long-term resources, which has a maturity of 7 to 10 years. And since we need to really plan for it, we did raise that money at that time. And that will be utilized in the next quarter. So we will be able to manage our excess liquidity within the control, within the 3 months normally, which we keep. Now it is around 6 months. Next 2 quarters, it should come down to around 8.5 level net interest margin, go up by to 8.5. And we should be able to maintain at 8.5 for the full financial year.
Okay, so margins should recover to 8.5, which is where you were in the third quarter. Q4, it dipped a bit, but you're saying it'll go back to 8.5 and sustain there. Got that point. Sir, on gold loans, just to go back, I mean, you gave us a whole breakup, how you were arriving at the 15% AUM growth expectation for the year. On gold, really, what's going on? We were just discussing this with Mr. Selvan, when one of your peer NBFCs just earlier. They're also getting into gold loans. It's a very exciting market, it seems. But what's the situation on ground? Is there too much competitive intensity? And the RBI obviously is looking at it with hawk-eye. And some sense of the growth. I mean, how do you come back to growth? Will it be Q1, Q2? And for the full year, what do you expect from your gold book?
Now, if you really look at how the gold financing happens, more than 50% of the gold financing, I still believe, is with the pawn brokers and the unregistered lenders. So there is a huge scope and opportunity because people would like to walk in to nearest place, nearest pawnbroker or jewelry shop for raising money. That's how it happens. So the kind of holding Indians have the gold is one of the highest in the world. So if you are able to plan it well, if you are having a branch network and contact with the customer, then we'll be able to grow the gold. So there is enough scope and opportunity for gold financing. And especially at the time when the gold prices are going up, it's an extremely safe lending opportunity for us. And also to the existing customer of ours. There are many SME customers, two-wheeler customer, any customer for a small requirement, temporary requirement, a working capital requirement, he can go to the nearest office of ours and raise money. So that is the opportunity.
Yeah, it's a very powerful sort of instrument now with gold prices being where they are at the hands of the borrower, which is why just trying to get an estimate. Full year, what is your AUM target for gold loan growth?
See, we are at around 5,500 crores. We are planning for a growth of 20% plus. We should reach around 7,000 to 7,500 crores in this financial year.
All right, Mr. Revankar, thank you very much, sir. Good speaking with you. Thank you very much for joining us with those details. So 15% growth, credit costs 2% plus minus 0.5%, margins about 8.5%. These are what Shriram is aiming to do as we look ahead into F526.
Interesting because the stock is trading at very juicy valuations, at the start of today and post the 7% downtick as well. If you look at it on the price to book or PE or even the return ratios. But for the timing, 15% frontline name getting a hit like that, in a couple of trading sessions, it's a little bit worrying.
Hearing him, you wonder whether 15%, where's such huge concern coming in? Because
management
doesn't sound so concerned.
The entire story of Shriram got re-rated. It was a merger, right? It was Shriram Transport Finance, Shriram City Union.
Yeah.
Transport Finance was lumpy. City Union was kind of stable.
Smaller business,
but stable.
Stable, yeah.
So that provided stability. And the business started re-rating 2 years back. Otherwise, it always used to be the cheapest, by far the cheapest NBFC.
Indeed.
So I don't know if the market is making too much of it. And it's not, because on Friday it was down. And I think, as you guys said, over the last 2 weeks or so, it's down 13-14%. So it's actually the first hit we've seen in many quarters on the asset quality side.
I think on the valuation parameter, if you compare it with Chola, it's trading at 50% discount in comparison to it. So it's trading, I think, at around 1.5, 1.4 times or thereabouts.
All right, well, let's just quickly take a look at what the market is doing. So it was doing very well earlier when we looked at it 15 minutes back. Oh, wow, 188 points on the Nifty. So just shrugging off, some of these worries at the margin and just sort of charging ahead. 24,230 is where the Nifty is at. Is a 200-point pop, which we have. So this is basically a complete reversal of what we saw, almost a complete reversal of the 250-point drop that we saw coming through on Friday. So very good going so far. Market breadth is not wildly positive, but 1340 stocks are higher and about 1150 stocks are lower at this stage. And I mean, sectorally, if I just want to take a look at it, so it's oil and gas, defense, and PSUs. That's the bulk of where gains are coming in from. Maybe a pharma, FMCG. I mean, actually, very few things actually down and out. IT is a notable loser. It's the biggest 0.9% cut on the IT index after the bounce that we saw, I guess, last week. Mitesh is with us. Mitesh, what would you do in terms of trades?
Good morning again, Prashant. I think a couple of names, Supreme Industries is one which has caught my attention today in the F&O segment. It's cleared the last few days of pivot of around 35. So keep the stop just below that. look for target of around 36.75, 36.80 to begin with, and eventually one can look at even higher levels. The other stock which I like is Lupin, which is just at the 200 average. So here I'll give a conditional trade. If it starts getting past 2095, buy with a stop at about 2070 for a target of 2050.
Okay, all right, got it. Thanks, Mitesh, so much for that. We'll take a quick break, come back on the other side. We'll have Manisha Gupta joining in with the latest from the commodity markets. Welcome back. So the markets are cruising along 217 points higher. Mid-caps are also in fine form. Actually, all the key indices, Bank Nifty, Nifty, mid-cap, everything's up about 1%. So it's a good Monday morning, good start to trade. As promised, let's now shift the focus to the commodity markets. We have Manisha joining in with the latest. Manisha, good morning. So what did the weekend bring?
Well, profit taking in metals. So you have gold prices down almost 6% off from its all-time highs, and the metal prices are down by a percentage point in the Asian markets right now. But what seems to be doing better really is the crude oil prices. After that very sharp decline that we saw on Friday when the prices fell by 2%, we have seen some bit of a opportunity buying coming into the markets. Well, the reason for that is that you have China and Politburo meeting over the weekend on stabilized jobs and unemployment insurance funds as well. There also is more conversation continuing, and in retaliation or on reaction to the tariffs, there is an expectation that China would be looking to increase consumption, and we could be looking at some more measures coming in. And then there is an explosion on the weekend at Iran's Bandar Abbas port on Sunday, and that has also added some premium to the prices. Markets also are seeing some support on the back of uncertainty in sense of trade talks in US and China, with an expectation that you could be looking at a step back from both of those countries coming in. US already has said that there are conversations going in, and there have been reports on how US has softened the rhetoric and China has exempted some US imports from 125% tariffs. But that's exactly where the bullish cues for the crude oil prices end. Because come the month of May, you will have OPEC and allies increasing supplies by 411,000 barrels per day. And the expectation is that you could be looking at more barrels being added from the month of June as well. Also, when you look at various statements, we do understand that there is some kind of a disagreement with various OPEC and allies members, Kazakhstan and Iraq especially, saying that they will be adding more barrels. So this disagreement also poses a downside risk when it comes to the crude oil prices. The US dollar index has strengthened. It's off its 3-year highs. You also have US-Iran reporting signing of progress in nuclear talks in this week itself. So those are some of the factors which have led to premium going off in sense of crude oil prices. IMF cutting US growth by to 1.8%, recession odds being added to 40% are some of the other factors also. So when you look at the prices, while we may be 1.5% up on a weekly basis, but in this year until now, we are down by 12% for the crude oil prices. And when you look at the last 12 months, we are down 24% in sense of crude prices. But this is going to be an important week because you have so much data coming every day of this week. Monday, that's today, you have Canadian federal elections. Tuesday, you have consumer confidence numbers coming in. If you look at Wednesday, you have first quarter GDP numbers, employment numbers, pending home sales, and Bank of Japan monetary policy meeting. That's also on Wednesday. Thursday is US weekly jobless claims, and on Friday, you have US non-farm payroll data. So as I said, every single day there is data coming in from the global markets, and that would set course ahead.
All right. Thank you very much. Commodities there in focus, Manisha. Appreciate it. Well, what's the MFI pack doing? The microfinance stocks doing? A news flow coming out of Tamil Nadu, a little disturbing from a lender's point of view. Abhishek, take it away.
Well, it began with Karnataka and now flowing into Tamil Nadu as well. So, as per news report, Tamil Nadu Money Laundering Entities Bill 2025 has been laid down. The key objective over there is to protect economically weaker sections from coercive, practices by money lending entities. So, there are three key provisions which have been mentioned over there. 3-year jail term for coercive recoveries. Loan recovery agents can be penalized for harassing borrowers or their family members. Microfinance institutions are prohibited from forcibly collecting dues, and dues to be resolved through district level committees only. So the impact on MFI companies would be that there would be a short-term impact with respect to disruption in their operations and collection efficiency over there. So there can be a dip in collection efficiency as and when this gets implemented. A potential exception would be the MFIs registered and regulated by RBI might be kept out of the bill's ambit. So state-specific impact with reference to the percentage of book or presence over there. Tamil Nadu accounts for significant portion of AUM for microfinance entities like Credac, almost 20%, L&T Finance, around 20% of the rural branch network is in the state of Tamil Nadu. Equita Small Finance Bank has a huge presence in the state of Tamil Nadu as well. Others who have smaller exposure over there, Fusion Microfinance that has about 6 to 7% exposure over there, and Spandaran less than 2 or 3% of their book is in the state of Tamil Nadu. Back to you.
Okay, all right, got that. Abhishek, thank you very much for the details over there. We need to take a quick break. On the other side, we will be chatting with the management of IDFC First Bank, talk about the bank's fourth quarter performance and the outlook ahead.
Okay, we continue with our earnings analysis, and IDFC First Bank is in focus. It reported a weak set of numbers compared to what the market was expecting. Net interest income and profit after tax came in below CNBC-TV18 polls, while FY25 credit cost ratio was above even the company's own guidance. However, the non-MFI stress was stable quarter on quarter, and that is a very big positive. To discuss these and more, we have with us the big man himself, V. Vaidyanathan, Managing Director and CEO at IDFC First Bank. Good morning, Mr. Vaidyanathan. Thank you very much indeed for your time. Actually, the market is worried about both stress and income because the numbers came in adverse. Can you first tell us about this whole credit cost issue? It's high. How do you see it going? It's higher than the guidance.
Well, actually, it's playing to script. Let's be very, let's put the numbers out properly out there. 2.45% is a credit cost for this year for the bank. And this includes the impact of the MFI and also includes the impact of that Mumbai entry point toll road issue, which is a legacy, the infrastructure account. If you take this thing out, because we'll talk about them separately, it's only 1.76%. And our gross NPA is holding up at about 1.87%. Net NPA is 0.83%. In credit cost, to complete the picture is 1.76%, excluding those two items. So actually, this is, like you rightly pointed out, that our MFI has been higher, but our core book, that's really good news, that it's very stable.
Okay. Would you say the worst of MFI stress is over?
Yes. Which, we should be very watchful. It's a very sensitive segment. I want to be really watchful. But let me just say that as we had said the last quarter, I had spoken at your channel also, we had said that Q4 will be the peak of provision. And then we said in Q1 should be less than Q4 and Q2 and so on progressively. We feel definitely it's progressing on this direction as far as the eyes can see. And best part of being able to establish that is the SMA pool, because SMA feeds to NP and provisions and all that. So our SMA pool has come down from 777 crores to 640 crores. So that is SMA 012 put together for MFI. The whole block has come down. So naturally, in the subsequent quarters, provision should come down.
Okay. Can you take us also through income? Your costs are high, obviously, because you're building the bank. But income has also kind of faltered. What kind of, income growth or interest income growth can you, guide us?
So income also, this MFI thing is affected on two fronts. We talked of credit costs. I don't repeat that because it is higher than expected. I also agree. It was high. But coming back to, but frankly, that happened to all the 200 players who played in this market. We are not the only players. But the other impact of MFI also was income, because we shrank the book, just for the record. We shrank the book from 13,500 crores as of March 31, 2024. So 9,500 crores is a big dip of 44,000 crores. So that also brought down income with it, because the yield on this book was like 23-24%.
So it's an interest reversal, is it?
No, the book shrank. So you accrue less income, like I told you the numbers. So basically the book, so composition of MFI in the book has come down from 7% 1 year ago to now maybe 4.8% now. Next year will come down to 3%. So net, we have ambitions of being, a large bank. We don't want to be forever be in the mid-tier bank. We want to be a larger bank category, and MFI cannot be a big portion of a book. So that is a phenomenon playing out. But to estimate the next year, let me put it like that, to your question. So we expect our OPEX to further moderate next year. Our OPEX growth last year was only 16%. Next year we're guiding to be like 13%. So OPEX coming down is a very material movement that should impact the operating profit and the PAT of the bank next year. But certainly short point is that we expect that 26 numbers of PAT to be much, much better than 25.
Actually, you took away my next question. I did want to talk to you about OPEX. Over 4,000 crores, right? Now, this near almost 5,000 crores. 4,991 is the OPEX. Now, this is like, pretty close to, say, Kotak's OPEX or something. And they have many, many more branches. So what explains such a large OPEX? And when will you be able to milk it? Because that also means cost to income is among the highest in the industry.
Yes, that's absolutely correct. So basically, we added, Lata, we had 200 branches 5 years ago. We have 1,000 branches now. We had 200 ATMs. We have 1,100 ATMs. We hired the people. We put up the infrastructure, the whole thing. We start up so many lines of businesses like cash management and FASTag and credit cards and the liability franchise, the current account. It's a new bank coming up. All things had to be spent. So that's the way it is. So, but the good news is that now incremental, let me just tell you 4 numbers. It will help you very easily to understand. YOY growth on OPEX for Q1 of last year was 21%. Q2 YOY growth was 18. Q3 was 16. Q4 is 12. You can clearly see we are really clamping down on OPEX now. And next year, we expect this to be only about 13%. So we are really going after OPEX, and there are many ways of going after it. And that, we believe, is a material reason why our PAT also should look up next year. The other thing, Lata, is that I want to just put the correct numbers in front of everybody so that it's very clear to expect from us. While the loan book next year may grow up by about 20% income growth will be like 14% because the microfinance component as a percentage will come down. But income comes down, income grows at a slower pace, but OPEX also grows at a slower pace. Operating profit will still improve next year meaningfully.
Okay. So the slowdown in income growth will be countered by the slowdown in OPEX growth as well, is what you're saying.
Absolutely. Right? And the year after that, now the bank is really well set because the machine's running, good franchise, good brand, all that has come. Now, when we look forward, let me say just 1 year forward, I don't want to get too far away, but let me say 27, we expect the income, OPEX to still grow only by that zone, like 13%, but we believe income will go up by 18 because by that time the microfinance would be in the base case itself. So I really expect that 27 to be materially improved and 26 also to be much better than 25.
Okay. But that also because you're stressing less on microfinance, your margins are coming down. I mean, you were 6+. Now you are a little short of 6% in terms of margins. What's the trend? If that will go down, then that again hurts income, hurts ROA.
No, it's true. Absolutely, you're right. You called it right. So the way we look at, I'll just put some numbers out to just put some clarity on this. So on the margins front, last quarter, which come down to something like 595, as we progress to becoming a large bank, I told you our ambitions of becoming one of them. So there'll be some sort of a moderation there. But let me give you a next 1 year picture. So we expect the repo rates to already come down to 25 basis points last quarter. We expect another 50 basis points to happen. So to the extent we have 30% of a book is linked to repo, we do expect the income to dip according to the amount. But good thing is that we're also going to cut the cost of deposits. Only today, might be just fresh off the press, we brought down our interest rates on fixed deposits to as low as the large banks. Okay. It's a very material development for us, like as low as the big banks. And, it was like a 200 basis points more than those banks 4 or 5 years ago. It's now like match the rates. So when we drop the rates also, this also will come down. But together, impact on margin next year should be 10 basis points over Q4 of FY25.
So 5.85 is what we should be prepared for, you're saying?
For next year, vis-a-vis 595 of this year.
Yeah, no, I see, that is understandable. You cannot always be at the 6% mark. But ultimately, as your OPEX, everything will crystallize in the ROA. So give us an ROA guidance. That also has fallen, which may, that perhaps explains why your stock is down 1.2% on a day when the market is up. The ROA would be a disappointment. What would your guidance be?
So we believe that by end of this financial year, we should go back to the 1% kind of a leak. And I agree, it's like 0.3, 0.4%. We had that twin impact, right? Income came down, credit cost went up. Just a strange combination of events came together from MFI. As the impact of MFI recedes over the next 4 quarters, ROA should come back to 1% is what we are working towards.
Okay. Do you release some money because of the lower LCR rules, especially in wholesale and even in retail, lower than at least the draft?
Well, it's much better than the draft guidelines. in the draft guidelines, as per them, it is much benign because the draft guidelines, we had to put out 10,000 crores of extra cash to meet LCR. In the new guideline, our expectation is about 1,000 crores. So it's like markedly better. And 1,000 crores for a big bank like us is really nothing, or for a size of our bank, really nothing. Think of it like 1 or 2 basis points.
Oh, that's excellent. So that also reduces costs
So
or
there's
at
no
least
issue.
improves margins in a big way. You have more money to lend to more profitable areas. So give us a guidance in terms of growth. Okay, the other vertical. What is the vertical you see giving you growth now that you've pulled back a little from microfinance? Will it be SME, MSME? What is your growth lever?
So there are four segments we work with. One is the retail segment. Second is the SME segment. Third is the commercial segment. Commercial is the sitting between SME to the large corporate, that commercial segment. The fourth is the corporate segment. And fifth is the agri segment. Think of it like these five sectors. And then also MFI. So we will, of course, mute MFI because, like I said, we don't want to be hostage to one product holding the bank hostage to numbers. So we will mute that. But the all other businesses are set for growth. In fact, since I'm on a channel, let me also say that we are looking to build a commercial banking team, the one that sits between the small corporate and large corporate. And we are looking to build a proper team there. So anybody hearing the program want to reach out to us for a proper role, I'll be happy to.
Okay. No, I wanted to just a final squeeze in a question, though we are being warned of end of time. Your cost per branch. Now, I have not done this math. It has come from someone who's watching this show and is sending the question. He says your cost per branch is as high as 19 crore, whereas for ICICI, HDFC Bank, Bank of Maharashtra, it's much lower at about 6-7 crores. Any reason why your branch, first of all, is this number right? Is your branch cost that much higher than your previous employer, ICICI? And why?
No, my previous employer is a great bank. But let me just say that these numbers are not are absolutely wrong. Actually, very misleading way of comparing banks, actually, because cost per branch is pretty much the same like every other bank, except that we are less branch-heavy bank. We have only 1,000 branches, and we are originating 50,000 crores a year of deposits because our digital machinery is running a very big way. And then we have so many other businesses that are running. Like imagine we're setting a card business. If you go load the card OPEX or a cash management OPEX onto a branch, how does it make sense? So these numbers are not exactly the right benchmark. The real thing is the bank has many new lines of business launched, which we had to do, and they all have a cost. So they have to look for their own independent paybacks and stuff, and they should not, we should not load them to a cost of a branch. A branch cost is similar to other banks.
Okay. Your previous great employer, KV Kamath, spoke to me recently. And, as he looked into the future, he said banks, given the way in which fintechs have come in and, technologies coming into the NBFCs, he said banks will have to cut their their cost to income to 1/4 their current number. And he was looking at, ICICI and saying they have to go down to 15%. Give us some guidance. What does your cost to income is sitting at 75? Where does it go to, say, in 2 years, in 3 years?
We think that a good, stable cost income of today's modern times, at this point of time, I agree with Mr. Kamath about the longer picture. But for now, it's more like the 50s, 40s, 50s, let me say late 40s kind of stuff.
Okay.
So we have no doubt that we will get there. Like we have zero doubt because it's just a skill. Nobody should forget. Nobody should forget. It's a 5-year-old bank or a 6-year-old bank. Those banks are 25, 30-year-old banks.
Yes.
You really can't compare. But when markets are markets, they always compare. So in the long run, I have no doubt in my head that we will get there. And I'll give you one number about how technology is really helping Tata in this cost-to-income ratio. Last year, we added only 58 branches. But our deposits went up by 25%. That is, we grew the branches by 7%, deposit up 25%. This year, we're planning to add branches only by 10%, but we expect deposits to grow by 23, 24%.
Yes.
So the power of technology is really showing at our bank, and we believe it will be material progress for the bank in the future. And finally, it's also helping the customer experience.
Okay. No, there's no taking away that everyone who looks at your bank is impressed by the deposit growth, even under very difficult circumstances. So take your point with that, and congratulations for that. Thank you very much for joining us, Mr. Vaidyanathan. Out of time, we have to wrap up on Bazaar. On that note, the market's still in very high spirits. Chartbusters will take the action forward.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and we have got plenty lined up on the show. So let's get straight to the action. Focusing on earnings first. Hindustan Zinc, well, they reported a pretty good set of numbers.